Well, good afternoon, everyone. Welcome to our episode 2 of this year's podcast. We have a lot to cover today. We haven't talked to you in about a month and a half, and a lot has happened. So we have a full agenda. We're going to talk about why did the market drop? And of course, we had a Fed decision yesterday. We're going to explain what happened there. And then there's some tax law changes coming around and some big things happening on April 2nd with the reciprocal tariffs. And we'll actually discuss potentially what kind of a year-end expectation we can have in the markets. So with that, we'll get right to it because we have a lot to cover. Dryden, been an uneventful month, as they say, or a few weeks. We've had a pretty good start of the year of the market, and then we had this 10% market correction in the S&P and about 14.7% correction in the NASDAQ. And people are wondering, it happened so quick, so fast. They're wondering why it happened. So can you, in plain English, explain what happened to the markets?
Well, I'm glad you asked for plain English because that's the only language I speak, unlike our daughter who speaks 7. But anyway, so why did the market drop? First of all, I think we have to separate headlines from bottom lines. And we had a market that had really gotten ahead of itself due to the expansion of really 7 companies. We saw the Magnificent Seven over the previous year, 2 years actually, really lead the market. There were the vast majority of the growth of the market. So they were overpriced. And then you had an interview where they were asking President Trump, like, well, what do you think about a recession? And he didn't say that there wasn't going to be one. So everybody sort of overreacted. There's a few overreaction moments, and I'll come back and dig into the depth of that in just a second. But the important thing to know is that markets tend to correct about every 13 months. And we had 17 months before we'd had a 10% correction. So we were due for about a 10% correction in the S&P. And when that happens, you get about a 15% correction in the NASDAQ. So this is part of the normal battle rhythm of a market. It happened quickly because, well, as I've said many times, do you know any irrational people? And so what happens is human beings kind of hear a piece of news, they overreact, and the overreaction feeds upon itself, and the next thing you know, you get out. So indeed, the market's fallen. The S&P went down 10% and bounced off of that. So that's kind of where we are now. We're bouncing around. There is plenty of things to have hyperbole about. So every time you turn around, people are talking about being worried about tariffs. They're talking about being worried about whatever comes out of President Trump's mouth. They're being worried about talking about whatever comes out of Elon Musk's mouth. And everyone is tend to this overreaction moment. So that serves as a catalyst for something that was due to happen anyway. Now, if you want to dig deeper into it, I'll give you an example. The Atlanta Fed came out with a statement that says, "Oh my gosh, first quarter GDP fell and we were in negative about 1.4." And what happened was they're saying, "Gosh, we've gone from a very positive GDP to a very negative GDP. We're headed into a recession." Blah blah blah. You get into it, and this is what your investment team does here, by the way. You begin to tear apart those numbers and you find out reality. Well, reality is that negative GDP print from the Atlanta Fed had to do with imports. So if you import a lot, it becomes a negative number. There's 2 things. You had companies pulling forward imports because they were trying to buy before tariffs went in because they knew that they were threatened. And 2, you had a lot of Americans buying gold. As a matter of fact, as you dug into it, it was first it's imports. Well, what's the imports? Oh, it's precious metals. Well, what's the precious metals? What's gold? So you had about a tenfold increase, more than that, of Americans buying gold in that one particular month. And that skewed all the numbers, and it took it from a positive to a negative. And if you pulled out the gold anomaly, you went back to a negative 0.4, right? So and even the Fed looked at this finally after they had published it and everybody panicked. They had to go back and say, oh, wait a minute, let's adjust gold out of this. So the point I'm trying to make is that you've got to be very, very careful about overreacting to headlines. Here at PWM, we're most interested in bottom lines, not headlines. And so we really kind of dig beneath those numbers. So be prepared, folks. For the next several months, you're going to hear a lot of hyperbole, and you're going to hear a lot of things that are designed in the press and the media to probably scare you and panic you for one reason or the other. And it's important to stop, breathe, take a look at the truth underneath all the noise. And what you're going to find out is that the economy is still fundamentally strong. It is fundamentally growing. We have inflation is a little bit higher, growth a little bit lower, but it's all a very good number. And that's why the Federal Reserve has said, look, we're not gonna raise rates. We're not raising rates. They came out and said that. And our next move is either going to be keep it where it is or maybe lower it. But we really think this is all about probably the Fed lowers one maybe after June. But after that, we're probably keeping these things fairly stable where they are. That's important. And I think really the market went down due to an overreaction of some comments and some misinterpretation of comments, and then it gets blown up. But what it was a catalyst for something that was going to happen normally. So now what do we do with this information going forward? I'll cover that in a little bit.
Basically, what Dryden is talking about is uncertainties. The market hates uncertainty. When you have the talk of tariffs and they talk about, 25%, then they go to 50%, then it's off and it's on. The market hates uncertainty. So they sell first and wait to see what happens. Once there's certainty, and it's going to take a while to be some certainty, but once there's certainty, in the marketplace, what's going to happen with the tariffs? We are going to have some sort of tariffs. There's no doubt about it. We don't know how much and who's going to pay it and what country and what area of the market, but we are going to have some, but we don't know how much. It's very hard for a company and for an analyst to price the earnings of a company if there's going to be tariffs. So what do? They overreact, they sell first, and then they wait around and see what happens.
I think what you're talking about is we saw this back when interest rates went way up. If you think about a tariff, companies look at it as that's an increase of maybe an increase in cost of business. They don't know whether it's reciprocal or not, or what that's going on, or what their costs are going to be. Back when you saw interest rates going up in 2022, chief financial officers had a really hard time of predicting prices for their goods and services because they didn't know what their cost of capital was going to be. You guys can remember me talking about that quite a bit. So if you don't know what your cost of capital is going to be, you're uncertain about your things going forward. Everybody pulled down their earnings estimates. And nobody quite knew how to price. Once they had certainty, they knew how to price their products. Profitability went up, margins went up, markets were very, very good. If you think about this as the same parallel, you would go, okay, tariffs could affect my pricing structure of my commodities, pricing structure of my product. I don't know quite how to do that until I have some certainty. It's very hard for me to predict my earnings. So I think, quite frankly, if you're looking forward to what's the symbol for corporate CFOs for the next 2 quarters is going to be a sandbag. I think they're going to be sandbagging their earnings. They're going to be kind of talking them down because they have some uncertainty in it. And I think what you're going to see is when you get into third and fourth quarter, you're going to see a lot of earnings surprises. And indeed, 75% of companies are beating their earnings today now. So earnings still look pretty darn good, which is, again, why we look at this correction in the market. We look at this drawdown as part of the normal course of things. We look at it as an opportunity. We look at it, as I say many times, take advantage of volatility. Don't be its victim. And we look at this as an opportunity as opposed to a problem.
Yeah, I mean, the very good example that Dryden gave is about interest rates. We started interest rate drop in 2022, and it kept going up, and it kept going up, and it kept going up, and the market kept going down because we didn't know. And then the Fed would raise rates some more. And then once they stopped, even though rates went to 0 to 5.25, and the cost of capital was so much more for these companies. Once they stopped and the market knew there was certainty that was it, they adjusted the earnings and life went on and the market did very well. We basically, once we have some certainty into the tariffs, it will be a one-time thing. It will be behind us. Market will adjust. And that is really the most important message we want to give you is that, yeah, whenever there's something new, whenever there's uncertainty, that always causes these kinds of things in the market. Now, this happened a lot more uncertainty because of the change constantly. And that caused even more volatility. If it was just said 25% and went on, the market would have adjusted already, but it's not the case, and we have to live with it.
So I think it's fair for everybody to, if you think about from now for the next 6 or 7 months, you're going to have these periods. We're going to bounce around a little bit. And again, but I think that it's important for everybody to quit worrying about the headlines. No, we're focused on the bottom lines, and that those tend to look pretty good. Now, talking about bottom lines, as you've said many, many times, Layla, it's not how much you make, it's how much you keep. That's important. And so one of the big, while tariffs are, and by the way, folks, everything a government does is either a tax or a subsidy. If you look at any fiscal policy thing, you can break it down. It's either a tax or a subsidy. And so when we take a look at consumers' bottom line, taxpayers' bottom line, that's one of the things that affects you the most are the taxes. And Layla, they've called you the tax whisperer, and you're a pro at this. So talk to us about the changes that are proposed in the tax law and how that's going to affect people going forward.
I would love to, because I believe, like Dryden says, the tariff is a tax. We need a tax cut. This tax cut, that basically the framework of this tax plan has already passed the House. It's in the hand of the Senate. It's a frame of how much tax cuts we're going to have. Basically, as far as we know, as of now, we know that they're going to extend the current tax, Trump tax law from 10 years ago. But in addition, there's several new stimulus, and they are stimulus, and they're huge stimulus. For example, the fact that he could eliminate taxes on Social Security, it'll cost $1.1 trillion. Elimination tax on tips, tax on overtime, increasing the SALT deduction. Both Democrats and Republicans really want a higher SALT deduction. That's the deduction for state and income taxes and real estate taxes. As you know, in California, we pay a lot of taxes, and we have a huge, we lost quite a bit by not having that higher deduction. We don't know what it'll be. It's not going to be completely back to what it was, but it could be 30,000 instead of 10,000. It could be 40,000, somewhere in that number. And that's a huge benefit to many of us here that live in the wonderful state of California. Also, allowing companies that are domiciled in the United States potentially lower corporate tax, because the whole idea with this tariffs is to potentially bring in more businesses and companies domiciled in the United States. Now, how is he going to pay for all that? This is always a question, because they want to balance the budget. Well, it looks like they want to eliminate the EV tax credit. Eliminating the EV tax credit will save the government $700 billion. If interest rate was to go down by 1%, that's a saving of $200 billion. There'll be some other spending cuts in the DOGE cuts. Also, there's some tariffs. One of the reasons the tax cuts are going to happen is because we expect some tariffs. So there's going to be a balance. But at the end of the day, the market, GDP is all about consumer spending. Consumer spending represents 70% of GDP. If you give the consumer more money to spend by cutting taxes on Social Security, on tips, on overtime, and keeping the tax law changed, but really having that stimulus, people will spend. I talk to clients every day. I am going through tax projection right now, and I said, if you didn't have to pay taxes on your Social Security this year, you're going to save $25,000. You're going to save $30,000. It's huge savings. Many of my clients saying, we're going to take trips, we're going to do this, we're going to do that. People, especially in retirees, they want to spend that money they save. And so we feel that is going to be a huge stimulus. In his first administration, he kind of did the opposite of what he's doing right now. He actually had the tax cuts first and then raised tariffs. This year, unfortunately, he's doing it the opposite way. He's raising tariffs first, which is a big shock, much higher tax tariffs than the first term. But nevertheless, there are going to be tariffs. So he's doing that first, and then the tax cuts are going to come later. And we believe that would be where the bounce of the markets and things will be looking a lot better. I'm going to be talking a lot more in details about that in our upcoming luncheon, which all of you should have received the invitations already. And if you have not received your luncheon invitation, whether you could attend in person or in Zoom, please email us right after this session here. And we'll make sure that you get one. Because hopefully we'll have more clarity on a lot of these things, and we'll go into it in details. We should also have some clarity on the tariff situation at that time, because there is a big date coming up here that I want Dryden to cover right now, which is the April 2nd tariffs, which there will be some reciprocal tariffs put on. Dryden, can you go through and tell us what that is and what are some of these countries paying now? And what was it like in 1913 in the United States?
Well, so I think a little history. Up until 1913, the United States did not even have an income tax. The income tax was put on in 1913 as a temporary tax for the government to fund itself. Up until that time, we, the United States, funded ourselves through tariffs. And many countries around the world fund themselves through tariffs. And if you think about a tariff is in many ways a tax on somebody else. So if a government's going to fund themselves, they can tax their citizens, income tax, or they can tax somebody else through a tariff. And so right now, the net effective tax rate in the United States is about, for tariffs, right, is 2.4%. Very, very low relative to many other countries. So what the president has said is, all right, if you're taxing us a certain amount, we're going to giving us a tariff a certain amount, we're going to do the same thing. We're going to reciprocate. You tax us 20%, we're going to tax you 20%. You tax us 50%, we're going to tax you 50%. And this is the point. And the economic theory that everybody wants to come back to and says, oh my goodness, tariffs are horrible, is that reciprocal free trade is good. Reciprocal free trade is the most efficient way to allocate capital and resources around the world, let countries do what they do best, right? However, if there's tariffs involved, it's not reciprocal. The whole thing is people forget the idea of reciprocal. So the president has now said, okay, reciprocal can be 0 or it can be 100. You guys pick. And I think that that's an important issue. So you have a situation where, because he's coming to the table with, we're going to have reciprocal taxation, reciprocal tariffs, which you're probably going to see in many cases, and it's already beginning to show up, is countries that have tariffs on U.S. products are going to probably lower theirs in order, because they're, basically they're going to look at their trade with the United States and they're going to recognize we're far more important to them than they are to us. And therefore, what they're going to end up doing, they need us more than we need them, and they're going to end up lowering their tariffs in order to meet the reciprocation provisions. So this is one of these things that are important. When we look at the European Union, that we get on 25% is what they're talking about. And we're talking about major exporters, 25%. We're taking a look at most of all the countries that are undetermined and they have VATs and things like that. And it's there. So when you take a look at all of these countries, and he says, we're just going to treat you the same way you treat us. It can be a lot or it can be a little. In most cases, what you'll see is countries that have been having high tariffs on U.S. products are going to lower them, because that's what's in their best interest. Because again, they need us more than we need them. We've got buyer's leverage. So the bottom line to all of this is twofold. A, we are not terrified of tariffs. We are not terrified of tariffs. The president has found his weapon of choice in policy. It's a unilateral, and I talked about this last time. A tariff is a sanction that can be unilaterally imposed and delivers a economic benefit to the sanctionor. So in this particular case, the president has discovered his weapon of choice in international trade and international relations. He's been able to wield it highly effectively. And what's going on is, now that he's put this all on the table, you're going to see many countries very, very quickly begin to adjust how they treat us in a trade circumstance. And there's going to be a period of adjustment. There's going to be a period of hyperbole.
Volatility.
There's going to be a period of a lot of stuff going on. But those things, that volatility is relatively short-lived. It takes companies like Walmart maybe about 9 months to move their supply chains from one country to the next. And many, many people have built up inventories ahead of this. So your period of variant here is going to be maybe like 6 months. And when that happens, you come out on the other side in a circumstance that's probably better for everybody. So, and this is going to become self-evident, we believe. So my whole point to all of this, April 2nd is a moment of volatility. Everybody's jockeying for position. So up until now, up until April 2nd, there's going to be a lot of announcements and a lot of adjustments. April 2nd, for probably 60 or 90 days, there's going to be a whole lot of movement of things like that. It is going to be volatile, but in the end, you're going to probably end up in a better space than we are right now. And I think that's the important lesson to take away from this, because countries that have high tariffs on us will most likely lower them rather than rise them. And that's going to be important. That's going to be good for U.S. manufacturers. That's going to be good for U.S. exporters, right? We're going to, because it goes to reciprocal, right? That's going to be important. And the other point is that these are not all one-to-one, and these are not components, and things can move around from one supplier to another. If you give a level playing field to American commerce, they figure out how to win. You give a level playing field to American companies, they figure out how to win. They become more efficient. We get higher labor productivity. We come out on the other side in a better position than we are now. So we're excited about this moving forward. We think
It's an adjustment period.
and it's going to be an adjustment period, but it's not an adjustment period to be scared of. Like I said, we are not terrified of tariffs.
Even the Federal Reserve yesterday said pretty much the same thing. He says it's transitory. He used the word transitory again. And it's an adjustment period. And that's why he only lowered his GDP number from 2.1 to 1.6, which really brings me to the question, Dryden. People are so panicking about recession. All these government people losing their job, people are going to be fired, or there's all these job losses, and because of tariffs, is there potential at all for recession?
We don't see it. I mean, the short answer is, first of all, the government labor force is actually relatively small compared to the total labor force. Now, if you live in Washington, D.C., yeah, you got a problem. But in most cases, the total ratio of government employees and things like that to the rest of the labor force is relatively small. You have, probably 1.1 jobs for every person looking. Our economic system certainly has the ability to absorb a bunch of layoffs of federal workers. I find it very, very interesting at this point, and I'm going to riff for just a second. I find it very, very interesting at this point. For the last 5 or 10 years, every time I've given a presentation, the question everybody gives me is, what are we going to do about the deficit? What are we going to do about the dollar? All of this stuff. Now we have a moment where you have an administration for the first time in 25 years that's going like, okay, we're going to do something about government wasteful spending. We're going to cut government spending. We're going to try to we're raising taxes we're raising taxes and revenue via tariffs. We're cutting expenses via government waste. We're working on this deficit problem. And the very same people are coming complaining to me about that. So I just find it interesting, folks. But
it happened quicker. It's
It-
not
it-
done the
it-
nicest way.
it
It's not
happens-
done-
it
it's
happens
not done
fast.
it could have been done better, but this is how it is. I mean, I can't
But
quite,
but let me
we want, but it
let me
could have been
finish
done
answering.
better.
Let me finish answering your question. The point is that when we look at, are we going to have a recession? The answer is we don't see it. We don't see it. We continue to have a very rapidly growing economy. We've added in the last 4 years, we've added the equivalent of the GDP of France. We have 1.1 jobs for every person looking. You're going to have some areas, some markets, some locations that are going to go through a temporary circumstance because of changing government spending. That doesn't necessarily mean there's a huge chance in consumer spending in the aggregate. We think that corporate profits and earnings still show about a 10% increase between now and the end of the year. So what you're going to see is if you just told everything constant, if earnings are going up by 10%, probably the stock market goes up by 10%. So we're looking at a high single digit, low double digit market for the year. That expectation has not changed. Bumpy on the way to get there, but the end state still remains the same. So no recession in our view, a positive market in our view, a bumpy ride to get there. Yep, hold on. But I think in general, all of these are adjustments that are long-term positive for the economy and our circumstances going forward, positive for the markets, positive for people's portfolios.
So volatility is here. Remember, the big catalyst for this market is going to be the tax cut changes. When you give people more money to spend in their pocket, they will spend, and that helps the economy because GDP is all about consumer spending. So that's going to be a huge catalyst in the second half of the year that's coming. The tax law changes could happen as quick as May, June. I know he talked about April. I think that's a little too quick. But within the next several months, we should know what these tax law changes are. And I think that would be a huge a catalyst for the market. We are going to be talking in a lot more details about what's happening with the markets. As you know, the title of our luncheon is Trump, Tariff, and Taxes. The three main things. We're going to go in way more details about this. The luncheon is April 26th, Saturday, April 26th, from 9:45 to noon. And then if you're in person, you'll get lunch after that. You can join us via Zoom. Please, if you don't have an invitation, email us. This is a great time to invite your friends, your kids, your relatives, your uncles and aunts, people you like, people you don't like, people you want to benefit. They can come in person, they can come via Zoom, but they must register in advance to attend. We are welcome, especially through the Zoom option. Certainly anyone could join us if they register through the Zoom option. And we also are going to have a speaker about cybersecurity that's going to give us, we've seen so many of our clients, a lot of scams out there. We want to protect you. We don't just care about making you money. We want to make sure that no one scams you and lets you know how to keep your money. So we have a professional that is going to come and speak to all of you. And we're going to cover a lot of planning ideas and the markets, of course, and go into a lot more detail. So please, this is our State of the Union address, is our luncheon, April 26th. After that, our next podcast will be May 22nd, Thursday, May 22nd. If you want to put it down from now so that you don't miss our next podcast as well. So with that, thank you so much for joining us this afternoon and have a great rest of the day.
Layla Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Dryden Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. The financial professionals affiliated with PWM are registered representatives with and securities and investment advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Pence Wealth Management PWM and LPL Financial are separate entities.